Here we go. Hello, everybody. Welcome back to another Wealth Management Advisory Club meeting. Today, we have Charles C. Weeks Jr. from Barrister Wealth to come and speak to us today. I'm just going to read a little bit about him, and then we're going to pass it off to him for the rest of the meeting. So Charles is a founding partner of Barrister, a registered investment advisor, which provides financial planning, investment management, and risk management for individuals, along with retirement plan and insurance solutions for business entities. Charles created and developed the undergraduate financial planning concentration and the continuing studies certificate in the financial planning at Stockton University, where he serves as the assistant professor of finance. Charles also founded Barrister High Learning LLC, which provides CFP exam review courses, along with financial literacy presentations for audiences ranging from students like us here today to senior citizens to seasoned financial advisors. Additionally, he writes for his financial literacy blog, Unbroke, which can be found at www.unbrokenet.net. Charles received his bachelor's of science degree from LaSalle University in finance with a minor in accounting and his Juris Doctorate from Villanova University School of Law. So with that being said, I'm going to pass this off to Charles. Guys, let's please ask a lot of questions, a lot of fun with this meeting. And with that, I will let you take it over from here.
Thanks, Jack. Thanks everyone for either signing on or being there. I apologize I couldn't be there in person today. I know Zoom isn't the best. Doesn't really beat in person, but I have a 13-month-old at home now. First child, little boy. You can kind of see him in the background behind me. He kind of watches over me as I work. But what you guys will learn when you get to that stage of your life is you thought you were busy before. Then you thought you thought you were busy in school. You thought you were busy when you start working. Then once you have a family and you're trying to work, you realize what busy is. So you guys have that to look forward to. I want to try to make this as interactive as possible. So I know I'm not there in person, but Jack will be a great moderator. And please ask questions. Jump in at any point in time. It gets really boring just to hear me talk for a straight amount of time. So I would really like to try to make this as interactive as possible. Jack did give me some bullet points about some things we can discuss. So I'm going to give you a little bit of background about myself. That was, my bio that Jack read. It's just the bio, right? So there's always a whole story behind everything. I grew up down in South Jersey, actually a couple streets away from Stockton University. It was just Stockton College when I grew up down there in Galloway. Father never went to college, worked for the electric company. Mom worked for a family restaurant and went back to school when she was almost 40 when the restaurant closed. Very, middle class, blue collar family. Really kind of had to figure it out as I went along. So I always tell people, if you know exactly where you want to get to, you can follow that path. It's a very straight line. It's the best way to go. Other times you're going to find that throughout life, you might kind of veer off the path a little bit. And it takes you a little bit of time to get back on. So I'm definitely an example of someone that's veered. And I just give you some background about what that was like to kind of get me to where I am today. So ended up going to LaSalle for undergrad. Loved business and the markets, but didn't really have any idea of what a professional job was. Again, I didn't have any mentors or anybody in my family that kind of went to college and had a professional job. So I started with accounting because I really liked my first accounting professor. He told us great stories. He was a funny guy and kind of jumped on accounting. I ended up interning my junior year for Arthur Anderson back when that firm still existed. And I got put out on a 3-month engagement in the audit division where we literally had to take boxes of spreadsheets down. It was a warehouse of just boxes of spreadsheets. And we had to type in different inventory numbers for Rite Aid. They had a big inventory scandal. They fired Ernst & Young, their old auditors. Ernst & Young wouldn't share the Excel documents with Anderson, the new auditors. So as interns, we got to type up new Excel spreadsheets. So it was horrific, unless you like that kind of thing. So wasn't really what I wanted to do with my career. So I learned quickly through that experience that auditing wasn't for me. I was also, I was an accounting and finance double major. I dropped accounting to a minor and just focused on finance. Unfortunately, LaSalle isn't the greatest of schools for finance. It's a really strong accounting school, but not a great finance school. So there weren't a whole lot of options, for me to look for jobs. I started at Prudential Financial right out of school. And what I want to stress with everybody that's on the call and in the room is the financial services industry has not yet caught up from like a training program perspective or like kind of initial job offering. Financial services on the sell side, which you kind of are, which you are in wealth management, there's not like an amazing system of training programs yet. Whereas like on the accounting side and some other places, there are. So even if you're on the analyst side, so say you want to be an investment banker and you get an analyst job at Morgan Stanley or Goldman Sachs, there is a very direct route for you to do either training there and then get your CFA, or leave and get your MBA and come back. On the wealth management side, it's more just entrepreneurial. You're kind of given the responsibility to go build a book of business. So again, important to kind of know what the industry is offering and kind of what's out there. It's getting better, but they haven't really built out a whole ton of those type of training programs yet. So ended up coming out of school, got a job at Morgan Stanley. My naive mind thought that once you get a job at a place like that, they give you assets to manage. You do a good job and you move up the ranks and you get more and more assets. And the first day, this is 2001, the first day I literally got the phone book treatment. So my manager handed me a phone book, yellow pages, and said, try to build a business. Go ahead and start, trying to bring on clients. So it was really eye-opening. It wasn't what I really thought it was or what I signed up for. Back then, the industry was very proprietary. So if you brought on client assets, you were expected to invest in Morgan Stanley mutual funds. You got paid more for doing that. If you look at how those funds performed back then, Morgan Stanley doesn't have that anymore, that asset management division. They weren't very good, but you were still being pushed to sell those things. So it was still really proprietary, more of a sales job than anything else. Ended up leaving there to go to Villanova for law school because I decided that I, had this love for business and finance, but I was interested in law. I would just combine the two and become a corporate attorney. You don't take corporations to your second year in law school. You have to take all these other required courses first. And I realized in my second year that it just I wasn't passionate about it. I didn't love it. I could read finance textbooks. I can read personal finance books, investing books, bond books, whatever. I love that stuff. Law just was interesting. It wasn't a passion for me. So I figured I could either make a pretty miserable attorney or I would just graduate law school, focus on things in my third year that could transition back over to finance, and then hopefully use that degree to kind of move ahead in the finance world. So I studied trust and estate and tax law my third year, graduated in 2006, went to work immediately for Merrill Lynch as an advisor, now knowing what the industry was, but also knowing the industry had changed a lot. It was open architecture now. You didn't have to sell proprietary stuff. You could build your own business. So this was 2006. So it was kind of right before the Great Recession started. I started to build a book of business at Merrill Lynch. The Great Recession started, and my manager kind of came to me and said, you either have to join a team or you have to resign because you're bringing in assets and that's great, but you're not generating a whole lot of revenue. So that's kind of like a dirty little secret of the big wirehouse type firms still. There's still this focus, not so much on building a practice. There's still a focus on revenue generation. And then again, it's getting better. They're bringing younger people like yourselves in and putting you on teams right away or putting you in a financial planning center to get some experience before you're required to build a book. But back then it was just show me the money or you kind of have to move on. So there was really nobody that I wanted to team up with at the time. So I left there. I helped a couple people start their own independent firm, their own RIA, which I had no idea what that meant back then, but it was eye-opening. I now realize there was this whole other side of financial services, registered investment advisors, where you could be totally independent, manage assets how you want, choose the custodian that you want, focus on financial planning, and really offer what I think clients want. They don't want product. They don't want concerns that you're not acting as a fiduciary. They want to know that you're giving them the best advice possible, and they're happy to pay you for it. They just don't want the fees to be, kind of, what's the best word? Not transparent. I don't know how else to kind of word that, but just make it clean and cut. Like, this is what it is. So help them start their firm. And then 2010, I started Barrister. So wow, about 13 years ago now. So it's been a while. And guys, don't let people tell you can't do anything, because when I started Barrister, I had over 250 grand in student loan debt from LaSalle and Villanova Law. I got a job waiting tables. I moved in with my parents for a year, and I started the firm. So you would have to find a place to live if you bootstrap like that, but if you have that, you can start with very, very little. I did have my CFP, which is wildly important, and I really believe that is at some point that's going to become the CPA marks for, how they are for accountants. Or, if you're a lawyer, you have to pass the bar. If you're a medical doctor, you got to pass the boards. My wife is a nurse anesthetist. She had to pass medical boards to actually work. Yet our industry still doesn't have this kind of one standard where you have to have some type of accreditation. Yet you're dealing with people's money, which is arguably, other than their health and their family and religion, maybe is one of the most important things in their lives. So I do believe those marks eventually are going to be the end all for our industry. But I did have my CFP that definitely helped. Having my law degree helped. I had a lot of debt, but the mindset was, if I'm going to stay in this industry, I want to do it the way that I believe it should be done for people. And that's with a focus on financial planning, making fees as transparent as possible, and making them reasonable too. You'd be shocked. You could interview 10 different advisors from 10 different places and get 10 different sets of fees. Some are way up here and other ones are more reasonable. So I did that back in 2010, launched a firm. About a year later, I decided that I wanted to make some extra income and not necessarily wait tables to do that, to pay off my loans while I was building up the practice. So I tried to become a professor, just an adjunct. So I applied at Stockton for their adjunct program. They had an online resume system. I sent it in. 2 or 3 months later, I never heard back from anybody. So I emailed the dean of the business school and I said, I have this idea for Stockton. You can now have a board registered CFP program where the students take these courses, and when they pass, they can sit for the CFP exam right away. And if they pass the CFP exam, a few years of experience, they'll actually be practitioners. And I said, I was accounting and finance. I still had to go take all these extra classes just to be able to sit for the exam. So the dean emailed me back and said, I hope you're not looking for a job. I hope you're not a consultant trying to sell me anything, because I'm not hiring, I'm not buying, but I'll treat you to a free cafeteria lunch at the school if you come visit me. So I went, had the free cafeteria lunch. Wasn't that good, but the lunch was good. The dean really enjoyed the conversation and the talk about the program. The next semester, I was an adjunct teaching a basic personal finance course. The next semester after that, we had a CFP board approved program. So I served as a professor there. I actually have to update my resume, Jack. I don't teach at Stockton anymore. I resigned about a year ago.
Oh, geez.
No problem. I have to update it on mine. The good thing is the practice just got so busy that I couldn't juggle anymore the teaching and then running the practice as well. So I stopped doing that about a year ago, and then I don't teach the CFP courses anymore either. So it's really just been now a focus on Barrister, building the practice, and trying to make it the best practice it can be. So I know that was a very long-winded kind of background about my personal story, but I think it's important, because I think sometimes you can hear people's bios and you hear, oh, CFP, oh, JD, he's got his own practice. There must be, how that happened. It was a struggle. It didn't just happen overnight. It took a lot of time. It took a lot of struggling through my 20s of learning things and experiencing things and realizing what I liked and what I didn't like and what I could do and what I couldn't do, before starting at 31 and just taking a big risk and knowing that, and this is what I hope all you guys know, is that there's always potentially a job out there for you, but there may not be your own thing out there. Like if I try to start it now, I'm 44 with a 13-month-old at home and a wife and bills and a mortgage and all those other things, it would be a lot harder than starting it then. So being young and trying to launch something, even if it fails, who cares? You learned a lot. It didn't work out, but maybe you have something, you learn something that you can, maybe do something different in the future, or take that to whatever job you might have. So I'm going to just take a break for a second, have some water. Anybody have any questions or thoughts or anything?
Yeah, I think we have a question over here, I think from Sergio. As a CFP certified financial planner, can you explain how the financial planning process has evolved over the years and what changes you foresee in the near future?
Yeah, great question, Sergio. So I can tell you it's evolved more probably over the past 3 to 5 years than the decade before that, because I think, and I'm going to say, like, I'll sound cynical sometimes when I make some comments, but it's kind of like I feel like there's a reality out there to things. So the CFP marks are great. You learn a lot. It can help you earn more money. If you think about the organization itself, the organization, I think, struggles between practitioners building the marks and dealing with a bunch of practitioners from all walks of life. So you can be a CFP and you can work for New York Life and not strictly, but mostly sell life insurance. You could be a CFP and work at Merrill Lynch and mostly focus on investments. Or you could be a CFP that's independent that kind of does a little bit of everything, right? So the process itself hasn't changed a whole ton for a while, but the actual like implementation of it, that's changed a lot. Because I feel like there's a lot of advisors, even at places like, the insurance shops and the investment shops, and with RIAs too, there's a lot of RIAs that just focus on investments or just focus on insurance. People now are focusing on the process itself. So, meeting with your client, getting to know them, gathering a whole bunch of data, not just talking to them about, hey, what's in your IRA or your brokerage account, but do you have an umbrella policy? Like, have you done any estate planning? Send me your tax return, like these type of things, right? So gathering all the data, using these great tools that are out there now, like eMoney, Money Guide Pro, Advise-On, to like aggregate all this data, put together a plan, and actually follow up with clients to say, have you done it? Like, I use a tool called Meister Task, which is this online to-do list. It's awesome. I just list things that clients have to do. Like, hey, you got to buy an umbrella policy. Once they do it, mark it off, move it over, check it off. And then following up with clients, annually or whatever it is, to make sure that they're doing what they're supposed to be doing, that different things didn't pop up. I can tell you it's amazing. No matter how much you're on top of clients, it seems like every few months something new is changing with them. So there's always something that's going to impact their plan. So I would say the process itself, as written by the CFP board, hasn't changed like a ton. Little updates here and there, but the implementation across the industry, I feel like, has changed a lot.
That's great. Next question we have here is from Julia. How do you approach risk management when creating a financial plan for your clients, and what factors do you consider most important for tailoring it to their unique situations?
So when you say risk management, Jack, is the question pertaining to investment risk management or risk management, for insurance? Like, what's interesting about financial planning, if you do really take this holistic approach, I think we think risk management from, automatically you think investment, but it's really across the board. So would you like me to answer it that way or just specifically with investments?
I think she would she likes to hear both viewpoints.
Okay. So just across the board, think about it, and think about this with your own personal finances. There's kind of a level of risk that you're willing or unwilling to take across all aspects of your personal finances. So an emergency fund, do you or don't you have an emergency fund? If you do have one, do you have 3 months saved up, 6 months, a year? Well, kind of the more risky you are, you'd answer those questions differently. From an insurance perspective, you guys all have car insurance. How high is your deductible? If you have a really high deductible, you're kind of really a little bit more risky because you're saying, I'm willing to self-insure. Instead of having a $250 deductible, I'm going to have a $2,000 deductible. And I'm, going to drive a little bit more careful because from a risk management perspective, I'm taking on more risk by having this higher deductible. And it really goes across the board with everything. From a tax standpoint, are you going to take that extra deduction that there may be like a gray area in the tax code on whether the IRS would agree with you or not, that that's an allowable deduction? Well, that's risk management. Some people are more risky and they kind of operate a little bit more in the gray area with their taxes. From an investment perspective, the way we manage risk, I manage model ETF portfolios for clients. So when I'm doing my data gathering with clients, I have them fill out a risk tolerance questionnaire. We discuss their time horizon. So we look at two things. We look at their willingness to take on risk. That's the risk tolerance questionnaire. And then we look at their ability to take on risk. So someone might be super aggressive, but if they're 50 years old with 6 kids and they're trying to save for retirement, and they have, a lot of taxes that they owe, there's certain things that kind of don't allow you to take risk. You just have to be more conservative with your investments. So that's how we manage risk at the firm. And then those portfolios that I manage, those ETF portfolios, I'm using ETFs, so passive investment vehicles, but there is a small active management, portion to that where I'll just give you guys some examples. Like a year and a half ago, interest rates were super low. They weren't necessarily at zero yet, but they were almost there. I was worried about rising rates. So I sold all our long-term bonds, long-term bond ETFs from the portfolio. So LQD, TLT, got rid of those and swapped them for shorter-term ETFs like SHY, SHV, IGSB. If you think about the yield curve, right, the long-term versus short-term, if you think rates are going to go up, you don't want to own long-term bonds. They're going to be a terrible holding. For example, TLT, the 20-plus Treasury ETF for my shares, last year lost 29%. That's insane. It's a U.S. government bonds, but it was long dated. Rates went up, that got crushed. So from a risk management perspective, there's that aspect to it too, where there's these tactical changes within the portfolios that are being made.
Yeah. So next question comes from Louis. Can you discuss the role of, this is a good one, the role of technology in financial planning today? And how do you think it will impact the industry in the coming years with the rise of open AI and AI advancing?
Yeah, it's a great question. I think right now, technology is super beneficial for someone like myself who doesn't have a huge back office, right? I use Redtail for my client relationship management software. I use MeisterTask to make sure clients are staying on task with things. I use the eMoney for financial planning software, and it's awesome. It's really, really, really beneficial. Like things like AI, I think of that as like a robo-advisor, right? I could type into, ChatGPT, write out an investment plan for my clients, or write out a financial plan for a 35-year-old married person with 2 children that wants to retire at 65. They can spit it all out. I could spit it all out. It's not about spitting it out. It's about implementation and staying on track, making sure the clients are doing that. I don't know if humans will ever be replaced for that. And I think robo-advisors are a great example. For all intents and purposes, I run a robo-advisor with my model ETF portfolios. The difference is when clients are freaking out, they can go on Betterment and they can sell everything and no one's going to stop them. There was that issue where Betterment was actually trying to block people from selling. I don't know if you guys remember, that was a couple of years ago. But one of the biggest things I do for clients is when markets are getting crushed, or on the opposite side, where Bitcoin's at 60,000 and clients want to sell their entire IRA and invest in that, I'm there to talk them through that and advise them to say, like, look, no, like, terrible decision, not the right thing to do. I can tell you just with COVID, right? When COVID hit, the market dumped, all but one of my clients stayed invested and was much better off for it. I had one client who was a doctor who I begged not to sell. Literally the night before the market bottomed, he sold out of his entire $1.2 million IRA, went to cash. It took me 4 months to get him back invested. And that, it's not so much about what you lose just on that. He locked in a loss, took 4 months to reinvest. It's the compounding growth on what was lost that is really impactful, that people just don't appreciate. So I don't think that will ever be replaced.
Great. So next question comes from one of our EBOR members, Lindsay. This one's a good one. I asked this question. Actually, I'll actually take on this question because I've asked this question the past couple of speakers that came in, and I've gotten some weird responses about this. But with the recent surge in the popularity of cryptocurrencies and the other alternative investments that are out there, what are your thoughts on their role in a well-diversified portfolio? Because I've had actually, funny enough, we had someone that come in, I think who came in last week or 2 weeks ago, New York Life, that came in and they told us and they were like, we do not have any cryptocurrencies in our investments, none of them. We don't even consider it to be like a real asset. We just consider it to be just like, not even a huge deal. So I'm interested in hearing about what your take on that is.
Yeah, so I mean, I'd say I don't have any exposure in my client portfolios to it, and I'll tell you why. It's mainly the Tether issue. I don't know if you guys have looked into that at all, but until Tether actually gets audited, I'm unwilling to invest clients' assets in cryptocurrencies. Because if I can just print Tether and I can use Tether to go buy Bitcoin or use it to go buy anything else, and Tether is not actually backed by anything, that creates a huge issue in the crypto space.
Okay. Next question comes from Madison. How do you approach the topic of sustainable investing with your clients? And what are your thoughts on the growing importance of ESG, environmental, social, and governance factors in the investment process?
Yeah, so again, that's up to specific clients. I don't have any clients that invest the ESG right now. They're just not focused on that. My focus really is on more of just diversified portfolios, maximizing return, not with an ESG tilt to it. It's one of those things where I feel like if ESG, for companies that are focused on that, if it is beneficial from a valuation standpoint, those companies that are focusing on it will become bigger companies in the S&P 500, will be bigger companies in the Russell 1000. So as ESG succeeds, those companies will become bigger portions of the markets that we're already investing in. So I use a large cap ETF, the Russell 1000, and mid cap, the Russell mid cap, and then the Russell 2000 for small cap exposure. As ESG, becomes important within those companies of those indexes, naturally they'll become bigger parts of the index itself.
Good. So next question comes from Mitchell. Can you share some common misconceptions or pitfalls that people encounter in their financial planning journey and how to avoid them?
The number one thing is credit card debt. Just credit card debt is, and I think maybe your generation is better than some generations have been with it. At least that was my experience when I was a professor at Stockton, because I would talk to students a lot about credit card debt. And I think maybe because student loan debt is such a big focus of your generation, that your generation better avoids credit card debt. Although I will say, I feel like a firm and some of these, buy now, pay later type programs are being used a lot in lieu of credit cards. But if you don't pay them, they eventually become like credit cards. So it's something you have to be careful with. I would just think the biggest pitfall is debt, like bad debt. We'll just call it bad debt, whatever it might be. So it's really this focus on, right? You have your net worth, you have your assets minus your liabilities equals your net worth. You have this income that's going to start to come in when you start working. The focus should be right away, as soon as you're out of school, trying to put at least enough away in your 401k to get the company match and pay off any bad debt you have. Because if you have credit card debt or other debt that is compounding at 19, 20, 25, 30%, it doesn't matter if you're going to earn 12% on your 401k. You're just never going to get ahead.
Next question comes from Madison. In your experience, what are the most effective strategies for balancing short-term financial goals with long-term financial security?
Balancing short-term goals, I think that's more of like a personal question, depending on what those goals are. I would look at it like this. You have the short-term goals. You can't have your long-term goals without accomplishing your short-term ones first. So there's got to be, I look at it from how you want to invest for those type of goals. Like short-term stuff, 3 to 5 years, you want to be super careful. Like treasuries, money markets, CDs, you can't afford to lose money on that. So if you're saving for a down payment for a house over the next 3 to 5 years, you got to be super, super, super conservative. Long-term stuff at your age, at my age at 44, I am all risk. So I am all equity ETFs with a slug 20%, say, split between commodities and real estate ETFs. So I'm full risk on, knowing that I'm going to have this over the next 20 or 30 years as I continue to work, but I'm totally okay with that because I'm always buying into the markets. Short-term stuff, you just can't do that. So I think too, what the question might be is, how do I put money away for retirement if I want a down payment on a house? It's a kind of figuring out how long you're willing to wait to buy that house. We can always model it out for you and show you, hey, if you wait 10 years to buy a house, but you max out your 401k, this is where you'll end up at retirement. Whereas if you save for the house now and save for the 401k later, this is what you might have. And you just have to decide which one you're comfortable with.
Yeah. So next question comes from Haley. How do you help clients navigate the complexities of retirement planning? And what are some key factors to consider when planning for a successful retirement?
Yeah, so I'm big on, and eMoney does this, modeling out cash flows. So trying to sit down with clients and say, what is every dollar you're going to spend in retirement? Let's go through it. Let's look at what your healthcare is going to cost you. What's Medicare going to cost? Part A is going to be free, but we have to buy Part B. We have to buy Part D. We need a Medigap supplement, and really modeling out all those cash flows. When's it best to take Social Security? Let's try to maximize that. Do we take some from the portfolio now as opposed to later? Because if we take it now, we get to delay Social Security till 70, and you get this big 25% increase or 24% increase if you wait 3 years on your Social Security. So I would say it's really just sitting down and getting into the nitty gritty with clients, saying like, these are all the things we have to worry about, and modeling everything out. Let's see what the numbers tell us.
Yeah. Next question. Actually, I'll even ask a question. How important, and I know I probably talked about this in one of our club meetings in the past, but how important is diversification in portfolios? How important is that?
It's wildly important. So I tell people this all the time. A concentrated investment position, whether it's a stock or crypto or whatever you want to do, if you take all your money and put it in one place, it's a great way to get rich, and it's a great way to get poor. So if you've been lucky enough to buy Apple at $10 a share and you've made 10,000% on that investment, that's amazing. Now that you've made it, you should really diversify, because no one thought Kodak would go out of business when Kodak went out of business. When the great recession hit, no one ever thought Bear Stearns or Lehman Brothers would disappear, right? But it happens. It happens all the time. There's financial frauds like Enron. No one thought Enron was a fraud, So I would say diversification to me is super important. It's what I do for clients, right? I build these diversified ETF model portfolios, and if they want to hold a concentrated position, I keep it off the books in their own tradable account and say, you're in charge of that. Like, that's not what I do. It's not what I believe in. I also am very honest with clients. Like, look, you want to have your own trading account? That's great. I have one. I have a fun money account. I joke around. I call it my mad money account, like Jim Cramer. And it's for trading. It's for buying. And maybe I hit a grand slam. Maybe I don't. But it keeps me humble, because it shows me how little I know and how little everyone knows about what's going to happen. You think, like the smartest people in the world think that they'll come on CNBC or Bloomberg and they'll tell you everything about what's going to happen with the economy. They don't know. That's something important, that it's important you guys respect, people that have done well at different companies and things like that, just for the fact that they put in the work and everything, and you listen and you learn, right? But it's also important to question everything. Like, you should question everything and question everybody, not like negatively or nastily, but just question it. Like, I want to understand more. Why do you think that? Okay, well, show me that stuff. Give me some evidence behind it. Let me learn from it. But when you read Barron's or you read the Wall Street Journal, and somebody that's the head of research at Goldman or Citigroup tells you the S&P is going to be at 4,700 at the end of the year, their crystal ball looks just as clear as yours. So just keep that in mind.
Yeah. So next question comes from Ryan. Oh no, not that one. Where is it? As a financial planner, what are your thoughts on the importance of financial literacy education? How can we promote it to a wider audience?
That's a great question. We got to start teaching it in like 5th grade, like middle school. Like, I know some states, New Jersey being one, are implementing it in the curriculum. but it's ridiculous that we don't learn the time value of money in 8th grade. Like that should be part of 8th grade math, compounding, those type of things. So, I mean, as CFP practitioners, I try to go and speak at places. I do have the blog, which is actually becoming part of just a new website that I'm developing. It'll be part of the Barrister site, but I put all that stuff out for free. Part of it is just obviously for marketing purposes. People hop on there, they learn something, and they want to work with me. But also it's just free education for people that do want to learn. Go ahead, like watch the webinars, watch the videos. But I think it's shameful that if people don't, but I think there's the other side of it too. Some people took history in school and they didn't like it and they don't care and they don't want to learn about history. It's going to be the same thing with financial literacy. We can teach it in schools. Some people aren't going to like it, or they're going to struggle with it, or they're just not going to want to, they're not going to care to know about it. So there's always going to be a place for planners to help out.
Yeah. So next question we got here is from Sabrina. With increasing life expectancies and the rising cost of healthcare, how do you advise clients to prepare for more potential long-term care needs in their financial plans?
Yeah, great question. So I use hybrid policies. So they're hybrid in that they're a life insurance policy matched with a long-term care benefit. So they're not great life insurance policies. And I'll give you an example. If you take $50,000 and buy a whole life insurance policy, depending upon your age or whatever, you might get a $150,000 death benefit when you die. Well, this life insurance long-term care hybrid program, you take $50,000 of premium and you get $65,000 of death benefit for life insurance. So very little death benefit, but you get maybe 4 times that amount in long-term care benefits. So you get $200,000 of long-term care benefits. And then if at age 90 or 95, you decide that, you know what, I don't think anything's going to happen to me. I don't think I'm going to need long-term care. I just want my money back. The insurance company will actually give you your premium back they used to buy the policy. There's no growth on it or anything like that. So there's this loss, of potential growth, but at least gives you some optionality with the long-term care. Traditional long-term care, you don't see a lot of people buying it anymore. It's really expensive. And it's also just guaranteed renewable, meaning that the insurance companies can raise the premiums every year.
Yeah. So next question we have here is from Joseph. How do you approach estate planning with your clients, and what are some essential elements to consider when creating a comprehensive estate plan?
Good question. So I work with estate planning attorneys. So I typically just make the introduction at this point. I always recommend clients have at least a basic estate plan. So will, powers of attorney, one for healthcare, one for your finances, a living will, right? I mean, even you guys at your age, no one wants to think that they might die, but having a living will in place spells out how you want end-of-life treatment. Like if you want to be on a breathing tube, or if you want to be resuscitated, those type of things, so that your parents don't have to make that decision for you. I made sure my parents had a living will because I don't want to have to make the decision for them. So everyone should have at least a basic estate plan. It's not just for wealthy people.
Yeah. So the next question we have is from Zach. How do you help clients navigate the complexities of tax-efficient investing, and what strategies do you recommend for minimizing the impact of taxes on their portfolios?
Yep. So again, I run these model ETF portfolios. So the tax focus is really on end of the year, harvesting any losses there are in the portfolio to match against capital gains. And then if we can, create at least $3,000 of capital loss to put against their active income for the year. So you're able to offset your gains totally, and then you can use as much as $3,000 to actually lower your income from your job. So you can save, depending upon what your tax bracket is, $600 to more, $900, or a little bit more on your taxes doing that.
So next question we have is from Jacob. What are some, actually speaking of ETFs, what are some key factors to consider when selecting appropriate investment vehicles, such as, for example, mutual funds, ETFs, or individual stocks and bonds for a client's portfolio?
Yeah, so I use ETFs because they're more tax efficient than mutual funds. So they trade throughout the day on exchanges. So if you were to sell a mutual fund, you're not actually selling it. You're redeeming it back to the mutual fund company. So you own the Vanguard 500. You want to sell it today at 1 o'clock in the afternoon. You put your sell order in. At the close of the market, Vanguard will value their mutual fund. They'll look at their redemptions and they'll say, okay, well, Jack Mitchell wants to redeem 1,000 shares of the Vanguard 500. So this is what we'll send him in dollars. ETFs trade throughout the day. They're lower cost. Typically, Vanguard has great, cheap index mutual funds, but a lot of mutual funds are expensive. The internal expense ratio might be 1%, whereas you can buy an ETF for 20 basis points. So it's a lot cheaper. So that's why I use ETFs.
Yeah.
But I would say generally just cost is really important.
Yeah. So Caitlin asks, what are some challenges and opportunities you see facing the financial planning industry in the coming years, and how do you plan to adapt your practice to meet these challenges?
I mean, for me, I'm excited about the future. I'm 44. I have a focused kind of philosophy and process with how I work with clients. You guys should be excited about the industry. There's a lot of old people retiring. That's the reality of financial services. Because of what I told you guys in the very beginning of this, that the training programs weren't great, you end up with a lot of old people that have been at the firms for a really long time. And there's not so many people my age, and there's young people like you guys trying to get into the industry. So there's this big mismatch. So that's why some of the biggest firms are really focusing on, let's put together these teams now of advisors, because there's going to be this massive move of money where it's moving down. And it's not even just going to move down within the firm. Like, unfortunately, as older people pass away, the money's going to move down family generations. And you guys might not want to work with a 60-year-old at Morgan or Merrill. You might want to work with someone younger. So someone your own age, maybe. So again, like, I think the industry, the future is super bright.
Yeah. So the next question we have here is from who wants the next question? Oh, yeah, Lauren. What are some key considerations for individuals who are interested in starting their own business, and how can a financial planner help them navigate the financial aspects of entrepreneurship?
Good question. It's interesting working with business people, building plans out for business people. It's very similar to building plans out for individuals, other than most of the money from entrepreneurs doesn't go into markets. It goes into the business, right? Because that's their biggest asset. Now, I will tell you, conversations I have with entrepreneurs is like, hey, I know you want to invest in your business, but it's like a concentrated stock position. You're putting everything into the business. Maybe that's not the best thing for you to do. Maybe you want to diversify a little bit and put something off to the side, start a retirement plan, do those type of things. But the business is just like, from a cash flow standpoint, it's like anything else. The business has revenue. That's just like somebody getting a W-2 salary, right? That's the business's income. Business has expenses, got to manage those expenses well, just like an individual has to manage their expenses. Whether it's a business or a person, if they take on too much debt, pay too much in interest expense, the business can falter, the business can file for bankruptcy just like a person can. So they're similar in that way. I would say the biggest difference is just kind of where the money flows to. Maybe not so much markets, more to the business itself.
Yeah. So next question comes from Elena. How do you address the unique financial planning needs of clients from diverse backgrounds, such as those with non-traditional family structures or multi-generational households?
Yeah, great question. It's more from like a legal, it's not as different now for kind of non-diverse, non-traditional families as it was prior to the Supreme Court ruling that granted same-sex couples the same legal rights as other people. Prior to that, estate planning was really important, because if the states weren't recognizing same-sex marriages for spouses, then you had to make sure you really put something in place for the spouse to receive your assets. There's a ton of stories where someone tried to leave assets to their spouse, their same-sex spouse, and then the family fought it and the court ruled in favor of the family because there was no recognition prior to the Supreme Court ruling. So with that, you don't really have to worry about it as much. There's still some cases that pop up. But I would say if anything, it's more of a legal focus, like ownership, and then making sure that ownership is passed to the person you want it passed to.
Mhm. So next question we have is from Gabriella. Make sure I try to have the right one here for her. How do you help clients determine their ideal asset allocation? How often do you recommend revisiting and adjusting this allocation as their circumstances changes?
Yeah, so it's just in that upfront meeting that I have when we do the risk tolerance questionnaire, and we find out what model portfolio they'll fall in. It's either aggressive, conservative, moderate. They stay in that model unless they let me know that they're not comfortable with it. So it's really based on what they need, right? What they need and what risk they're willing to take. So you tell me you're going to retire at 67 and you're 45, and you're willing to save X amount of dollars. Well, you're going to need Y growth rate. And if Y growth rate's an aggressive portfolio, you're either going to accept that growth rate and that volatility, or you're going to tell me that you're not going to be able to, you need to be in a moderate portfolio. And instead of retiring at 65, I'm going to tell you have to retire at 70. So it's really that discussion that kind of leads to, their asset allocation.
Yeah. I'll even ask a question on my end. And I usually ask this question to one of our speakers to come in. With obviously, because me being an accounting major, obviously I might be planning on doing my actually I plan to do my CPA. But for some of our members here who are, want to go down, CFP, CFA, do you believe that it's important for, students to go into the wealth management to get their CFP or get their CFA or get both? Because I've heard from both sides of the coin, like, oh, get the CFA, oh, get the CFP, get both. But like, what's your perspective on that?
Yeah, I will say this too, Jack. I don't want to, I know my story in the beginning was negative about auditing and all that stuff. I do kind of wish I ended up in the tax department when I was an undergrad, and I wish I would have gotten my CPA at that point. I do look back on that. Having the CPA is an amazing designation, and it'll let you do a whole bunch of different stuff going forward. So even if you're thinking about finance, but you're accounting right now, go through the CPA stuff. Don't switch. Don't do that stuff. Get the CPA because you can always get the other marks later on. You can always get the CFP and the CFA. I would say from a wealth management perspective, if you want to go out and actually meet with clients and work with clients, you should get your CFP. That should be your primary focus. If you want to be a portfolio manager or be a hedge fund manager or work in private equity or venture capital, get your CFA. That's the deciding factor. It's what do you want to do? There's buy side and there's sell side. If you're on the sell side, meaning you want to go out there and sell your services and build a book of business and have your own clients, the CFP is the route to go. Having a CFA, you could be brilliant. You could build the best portfolios in the world. You could have your CFA. You could have passed it all in your first time. It won't matter if no one knows how good you are and if you can't go out and find clients. The name of the game in wealth management now is financial planning. It's not investment management. You have to go out and be able to speak to clients about everything, not just investments. Whereas if you're on the buy side and you want to run a portfolio, like you want to be a hedge fund manager, you want to run a mutual fund at a big investment firm, the CFA is the route. That's what they want to see. They want to see that you have that designation.
Yeah. Can you actually speak about the CFP exam for our members? Because I know we have done a workshop about the CFP exam, but can you explain to us what is it, like, what are the, what's like the exam like structure and like how like your perspective of the CFP exam, how you're able to do it, and like what tips and advice you might want to give to someone who might want to take the CFP exam one day?
Yeah, so I would say if you're not in a board registered program, when you graduate, you have to complete the education requirement first. So whether it's through American College or some other places, I don't know if your school does, Stockton does offer a continuing studies program, non-credit, where you can go through and take these courses. That's the first step. Once you get done those courses, you can do it in 9 months. Some places it'll take you 2 years to do. Depending upon what your underlying knowledge is, if you're going to take a fast track program, you really have to be on top of, you really have to know a lot of stuff, I would say, because it's just, they're going to glaze over things in these very fast track classes. So you might want to take the longer 2-year program, but you go through the education program first. I would recommend signing up for a boot camp. So like a 1 week test prep, a month before the CFP exam. but I would give yourselves a solid 3 months to study for the CFP exam, if not longer than that. I describe the CFP exam as a mile wide, but an inch deep. It's like a giant, really shallow puddle, right? It's just, you have to know a little bit about everything to get through the exam. So it's a heavy lift. You know, it's not the easiest thing to pass. If you work hard and you study, you can definitely pass it. But I think the CFA is harder. I tried to sit for the CFA level 1 the first year that I was teaching at Stockton. I just signed up for it. I didn't get a chance to really study. I just sat and took it. It's really hard. I would describe the CFA level 1 as every accounting and finance and quantitative analysis and statistics course you took in undergrad bunched up in one exam. So, and it's also international accounting standards. It's not even just, yeah, it's crazy. The CFP wasn't that like that, but yeah, it's a 1-day exam, all online. You study, you either pass or fail. There's no parts to pass. You just pass or fail all at once. And then after 3 years of experience, if you pass the ethics requirement, so for example, you don't have any felonies, those type of things, you'll become a CFP.
Yeah. All right. Does anyone have any last minute questions before I ask the final question of this meeting? Anybody? All right. I guess I'm going to ask the final question. All right. So usually this is the question I always ask, is a two-parter. The first part of that is if you had to go back into your past self, like back in college, what would be the one thing you want to tell yourself, your past self, that you wish you would have done? And now I do know in this room, and now we do have a couple of people here that I do know that are, I think majority of the room, we have freshmen, sophomores in here that are right now are on the fence about maybe doing finance, maybe doing wealth management as a major. But what advice would you give to them? Basically, you know, like, oh, like, should I do wealth management? Should I do finance as a major? Should I do wealth management minor? What advice would you give to them?
So is your wealth management major, is that specifically the CFP board register program?
Yes.
Okay. So I would say this, if you know 100% that you want to be in wealth management, go through the wealth management program. If you're a little unsure, stick with finance, because you can always go back and become a CFP. You don't want to pigeonhole yourself with a specific thing. I would say this, though, I wish I knew more about the industry, and I wish I would have been able to intern places. Again, I kind of went down that accounting route, so I missed out on things. Try to intern, try to get as much experience as you can in different places. Reach out to people like me and ask questions. You'd be surprised how willing people are to talk about things. So reach out. You can just Google like financial advisor and put in your zip code. You get 100 responses from people. Send some emails to them and say, hey, I'm thinking about doing this job. Can I talk to you about what it's like? And can I sit in your office maybe one day and see what you do? Some people like it and come in and get some experience, and just really be open and put yourself out there as much as possible. You'd be surprised what kind of doors can open up. Yeah.
Well, again, thank you so much, Charles, come speak to us today. I hope everyone here in this room will actually connect with him on LinkedIn after this meeting. Hopefully you guys will all do that. But yeah, thank you so much for coming to speak to us today.
Thanks, Jack. Take care. Have a good one.
Thank you. Bye. All righty, guys. Well, that was a great meeting, obviously. All right. A couple announcements that I have to make. And then, yeah. So next week is the last week of the spring semester for meetings. Thankfully for WMA, we're the final business club to end their meetings. So yay us. So next meeting, May 2nd, it will be not in Metro 13 form, but in the Bloomberg Labs on both Forum and Metro. Zoom, WMA Club Social, 6 p.m. Because I think for most of you who do not know this already, Morgan Stanley did pull out. We had an emergency that they had to take care of. So what we actually decided to do is that we'll be holding a Bloomberg workshop. Yes, so you guys will be able to use the Bloomberg Labs finally. We're able to teach you all the tricks and trades. And thanks to me being Bloomberg certified, I'm actually going to teach you guys this. So that will be at 6 p.m. That'll be a 2-hour workshop, spectacular. So that'll be awesome. Then the upcoming meetings events. So April 30th, we go FDU Day event. That is an FDU Admitted Students Day event for all of our admitted students that are going to be coming to FDU next semester. Obviously, it is open to all of our members here, so please come out, enjoy. It will be in the Student Center Mall, 10 a.m., 2 p.m. on April 30th on Sunday. Then on Thursday, the last event and the last meeting of the semester, we have the FDU Silverman recognition event on the Florida campus. I have no idea what the time for that event will be. However, it will be held in Lentville Hall or Hennessy Hall or, whatever everyone calls it. I call it Lentville Hall. And then the final meeting of the semester will be UWorld. It'll be yours truly and Janelle talking about goal setting. And we're also going to talk about the CPA exam and also CMA and the CFA exam as well. There is one thing I will mention. As most of you have known already, if you've not known, Gloria and I are the brand new president and vice president of Beta Alpha Psi Nu Sigma. And obviously we have been hearing some complaints from, I'm not going to say who, but they do not want us running both clubs. So with that being said, the E-board and I will be discussing this over the weekend, and that by next Tuesday, we will have an announcement, probably Friday or Saturday, actually, we'll have an announcement to make about this. Again, it does suck that we have to do this, but again, it is what is best for business. I really, really do appreciate this club. I hope you guys really do as much as I do. We can't really hold elections because we already held them in the fall, so we can't really do them again. Unless if I'm able to negotiate and see we get this club going for one more semester, be at the helm, and then I step down and maybe one of you guys could run the club. Obviously, it's not that I want to step away from it. It's just that things just come up, and I have to prioritize my career. So obviously I want to end on a sad note, but again, life, things happen in life. So again, we'll keep you guys posted about that. But again, the last week of the semester, we're going to end on a high note. We're going to end it on a bang, regardless of what's going on outside of these meetings. So, meeting on May 2nd in the Bloomberg Lab, Zoom Getaway Club, Social 6 to 8 p.m. Bloomberg workshop hosted by yours truly as well. If anyone has any questions, comments, concerns, please speak to me or my e-board or anyone here. Actually, just my e-board and May, obviously. And then what else do we have? Do we have anything else? No. All right. So with that being said, that is it. Thank you guys so much. Have a great rest of your week. We'll see you all back in the Bloomberg Labs on Tuesday. For those who are trying to get in the Bloomberg Lab for Tuesday's meeting, just let me know what time you're showing up, because I have to let you in, because unless you have access to it, because card swipe, it's a card mechanism. You just have to let me know. But yeah. With that being said, that's it. Great rest of your day. We'll see you guys next week.